Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and I've been wanting to interview this fellow for a long time since he wrote his last book. And I'm going to show you a copy of it here. It's How to Listen When Markets Speak. And by the way, we're going to talk about some topics today, but this is one of the best books I've read in probably 5 years. And I've recommended it to a lot of people. But Larry McDonald, I'm not going to go through really all of your history, but you've done about everything. I mean, I know all of your history on Wall Street, all your history on writing, the books you've written too, and you manage money. I mean, you're a Renaissance man for sure.
Thank you, Ted. Well, I just live by these words. You can get everything in life that you want if you just help enough other people get what they want, right? The old Zig Ziglar line.
Zig was one of my very, very favorite people.
Me
Dallas,
too.
Texas, Zig Ziglar. I still listen to his stuff today, but hey, I'm going to try to get into the book some, and I know there's some other things that have come up, but one of the things that you do is you spend some of the early part of the book talking about the government bailouts, deficits, where we are just with the government, and give me your thoughts on that.
Well, our first book was what's called The Colossal Failure of Common Sense. It was about the Lehman crash 16 years ago. And it was a New York Times bestseller. And I'm really proud. It was ranked by the CFA Institute as one of the best books in the world. But the most important point of that book for our audience of investors, people who care about the markets, is the fiscal and monetary response, Ted, to Lehman that we talked about in the first book was about $4 trillion, fiscal and monetary. And as I was creating this next book, When Markets Speak, I really started looking, okay, so this is, if you look at what we've done for COVID and the banks, because we actually had a banking crash last year, everybody kind of forgets about that. But if you add that up, that was 16 trillion of fiscal and monetary. And what blows me away is that the entire investment community, much of the financial intelligentsia, the media, they really expect the same kind of results coming out of, like, in other words, the previous decade, we had this long disinflationary period, right? And so what's amazing is all these smart people are basically trying to sell investors on the same thing happening this time, even though it's 4 trillion versus 16 trillion.
Yeah, that is so true. And I mean, I get the impression from the first few chapters, I've read it a couple of times, that it's so different this time, and people don't realize what's ahead of them, I should say, because of all of that.
Yeah, this is, well, for investors watching us, this is one of the greatest potential opportunities and also one of the most potential dangerous periods, because everybody's pretty much been in the same trade and it's worked for a long time, but there's a lot of secular forces that are changing that trade. And what we call is, I think that we're very close to what we call the great migration of capital. Right now, there's about 24 trillion in the NASDAQ 100 as of a month ago, 24 trillion in the NASDAQ 100. And that's about 21 trillion greater than the energy sector. So 21 trillion greater than the energy sector. And in 2014, 10 years ago, those were pretty much almost even. And so that tells you how far we've come since, over the last decade.
Well, and one of the things that you write about well, and we've thought this all along, is that, that with this greening of energy and all that sort of thing, I know people, it sounds good and people want good things out of that, but if you look at it, and we felt like, they just really missed the point that fossil fuel has to be around. You can't make it without it. And you write a lot about that as well.
Yes, and that's the point is that it's really a wonderful Pollyannish altruistic endeavor to go 100% green. But the point we make in the book is when you talk to people that are actually building the electric vehicles, you talk to people even people like Elon Musk, they'll tell you the carbon neutral 2050, and that's kind of the stated mandate from the government officials around the world. On the average, 2050 carbon neutral is really 2100 when you really talk to people that know. And then on the other side, we talk about India. We've taken 5 million jobs out of the United States. We've decimated the Rust Belt. Fathers go home to their kids working in jobs that are really very degrading relative to their family history in the United States and the Midwest and what we call the Rust Belt. But the good news is, for the globalists, we've raised the standard of living dramatically in countries like India. But in India, there's 1 billion people, Ted. There's 1 billion people that don't have air conditioning. 1 billion. And so we've taken all this money out of the United States. We've raised the standard of living, and we're creating all these new carbon consumers. So you're right. They're going to need a lot of oil and gas.
Well, and I tell that to people all the time. I said, you realize how many places in the world you have to have fossil fuel because you can't get electricity. I mean,
Yeah.
you have to have carbon. And I think people have overlooked that, and it's interesting. A lot of these narratives, you do a great job of this in the book about getting through the narratives to what's really happening. And that's why people have commented to me on your book, hey, you know what? This is the first fellow that's ever made any sense to me about what's really going on right now. So I've had a lot of comments about that. They were positive. But let me ask you, because we've had a problem with this too, but I think we said all along, everybody's in the same thing. But give me, you have some thoughts there on passive investing, ETFs, indexing, and what that has come to be, and you have a great outlook on it.
Well, the key part of the book is that it's really like working with great people. So after the first book, we did 150 speeches in 16 countries. And so we met some really talented asset managers. David Einhorn in the book was really helpful to me on the passive side. David Tepper. I mean, these are famous billionaire hedge fund managers. And Charlie Munger is, your investing style reminds me of good old Charlie. I mean, and it's so, I love Charlie, and he gave us an hour for this book. So the message is really about working with great people and bringing kind of their ideas together in the book. And one of the points around passive is that, the oldest boomers now are turning 80, and they've been through Lehman, they've been through COVID, so they've been through some volatile markets. And but if you really look at the way the passive universe is grown, I think Jack Bogle would probably be pretty miserable right now if he knew, because when I talk to really professional investors that know how markets work and really look inside of markets and try to listen when markets speak, I tell you, there's a real nasty cocktail forming in passive, because it takes a lot of the brains out of the investing. There's not, when you talk to people like Einhorn, there's nobody on the conference calls anymore. And so there's the amount of people that are actually looking at the companies, doing the due diligence, has gone by the wayside. We've handed that over to the BlackRocks and the State Streets. And, it's a really nasty kind of reversal coming out of that. And I think the next 10 years, you want to be positioning your capital with what we call active managers, like Greenlight, or like whatever number of active managers there are, somebody that actually has a team that manages money on an active basis relative to, too much crowding into the same trades in passive.
Well, Larry, and we're active managers because we think you have to know what you own, but and we don't own ETFs or indexes. But I would say this: I'm been curious about this. With the people we look at in the industry the last 15 years, and I say this many times, they most of them don't know the difference between an income statement and a balance sheet. I know it's sad to say, but they buy 11 or 12 of the ETFs or indexes, and hey, that's going to work for you for the next 20 years, and that's it. It's a one thought deal.
Right?
Don't you see that?
Oh, it's sheep herding. Each year it gets dumber and dumber and dumber, and it's worked for a nice while, but the demographics are going against it, and a lot of so think about like the last 30 years, right? If you look into the 90s and the 80s and the 2000s, the top 3 stocks were only 7-8% of the S&P, and now it's 21% as it reaches. That's really crazy thinking, to think that 3 companies can be 21% of the S&P, whereas in the 90s that was 8%. It's just crowded thinking, and it's extremely dangerous.
Well, and I've said this before. It's sort of, I wasn't in the market. I've been around a long time, but I wasn't in the market at the top of the Nifty 50, in 70. But but everybody owned the same things, so they sold the same things. It's even worse now. When they go to sell, they'll be selling the same things. Everybody. It's a trap door.
And you know what? The Oracle of Omaha, Buffett, can see this. And when you talk to, and I'm sure, Ted, you've been talking about this to your clients, but Buffett never hits bids the way he has sold Apple and Bank of America so aggressively in the most recent quarter. His cash is up 250% since 2022. That's, I think, we went back many, we've never seen that from Buffett, that kind of rate of change in a short period of time.
And I thought he would, because he was up to what, about 48% of Apple. And I thought he's been around a long time. He's not going to keep that level. And
No.
I'll be surprised if he's not selling more though in the third quarter.
Right. Me too.
Said and done. But, and then you talk a good bit about the other, we, like you just talked about, these asset bubbles that this whole central bank created. You talk a lot about that today too on your YouTube, but you talk about in the book though about bubble markets, crypto, real estate, all this other stuff, and people are all locked up in that as well.
Well, Ted, this passive trade, I'm sorry, this carry trade. We're moving over to carry. So the carry trade is a financing, and all it means, and it's created these bubbles where, because the central bank of Japan, the Bank of Japan, has been suppressing the cost of capital for many, many years. But in recent years, the planet went this way, Ted, right? So the cost of capital on Earth in Europe and the United States found kind of almost a free market equilibrium, almost, right? And so we went up like 300, 400, 500 basis points in yield, whereas they still stayed down and suppressed it, Ted. And so all these investors that are buying Bitcoin and they're buying the Magnificent Seven around the world, all it takes is 1 or 2 or 5 hedge funds plus a number of other investors to really borrow in yen at a depressed rate, take that money, and then invest it in all these other things. So you get this cheap financing, and every year it's gone on, it brings more and more players into it. And this week it really blew up, and that's what really laid a dent into some of these bubble trades, whether it be Nvidia, whether it be some of the Mag 7, or whether it be Bitcoin.
Well, and and I don't think the average person understands the carry trade, how dramatic that was. About, I don't know what you would say the average borrow was cost wise, but it was virtually nothing.
Right.
What they could get on the other side. And of course, that, like you say, that's, and I agree, they busted it down. It's not happening. But don't you think that created, I don't know what your thoughts are, created this, talking about a little bit about the real estate bubble, the crypto bubble. There's a lot of bubbles came out of that.
Yes. And for investors, like, why is this important for investors? Like this week, we had the largest increase in the VIX in like 1 or 2 days, which is the equity volatility index, since really Lehman, COVID, what we call Volmageddon. So it's one of the biggest moves. And here's an important thing. One of the things we talk about in the book, Ted, whenever you go, always remember, for younger investors, whenever you go, say, more than 300 days, 350 days without a 2% move in the market, whenever you get that first one, there's a probability of there's another one very close to it. In other words, that first 2% drawdown that we had maybe three weeks ago, now we've had 2 of them now, right? Inside of 3 weeks, where we almost went like 400 days without one. And another interesting thing is yesterday we had almost 535 lows on the NASDAQ. And once again, once you cross 400, the probability of you recrossing 400 again is very high. And so for investors watching us, this is a sign that some of these bubbles are being pricked, and you want to raise cash and really be there for what we call the great capitulation.
And in your bear traps report, which I take, you have a great graph in there on that 2% S&P. You've got a number of great graphs yesterday that you put in. One of the things you do great in your report, by the way, you put your money where your mouth is. I love people that manage money, because I can talk to them about things. If you just have people that talk about things, but you you manage money, you manage other people's money, you manage a lot of money, so you know what it's like to be on the line. But um, but talk a little bit about too, because you're at odds with a few people here on this. I happen to agree with you, by the way, on the dollar decline.
Well, listen, I mean, first of all, Trump was a known. Kamala is a known unknown, and there's uncertainty around the election. So that's been putting some pressure on the dollar because she's risen in the polls quite dramatically. The media has really given us a sales pitch on her, and God bless them. It's their convention coming up, I think next week or the week after, and so that's putting a dent in the dollar. But the big secular shift is if the interest Ted as a percentage of the tax receipts is 25%, Ted. Interest as a percentage of tax receipts in most AA, AAA sovereign countries, that should be in the 1 to 5%, maybe 6% bucket. And so the only way we can get out of this is if the Fed keeps interest rates below the rate of inflation. Well, that's what's called financial repression. We talk about in the book. So at some point in the next year, because interest is over $1 trillion, $1.3 trillion a year, they're going to get forced to cut rates aggressively. That weakens the dollar. And I think it's as sure as God made little green apples, you're going to get a weaker dollar a year from today.
Well, and at the same time, you won't put, like before, you won't have inflation down there underneath it, like you talk about. It'll be above it.
Right. And that's the thing is we're going into an economic slowdown with a deficit of around 7% of GDP. That's World War I, World War II. So all the ingredients, whether it be reshoring, right? The politics of reshoring. Obama told us those jobs are never coming back. Remember against Romney? And now the Biden team and the Harris team want to reshore, and so does Trump. Trump started this whole reshoring thing. So the reshoring is very inflationary. Obviously, we talk about in the book what we call supply chains and multipolar world. I sat down with Neil Ferguson, and he's like, listen, I sat down with James Baker in Abu Dhabi, the former Treasury Secretary. They're like, listen, when you go to a multipolar world, it's much more inflationary. And so we're going to have a much higher level of inflation. And remember, the way to get out of this with $35 trillion of debt is the Fed wants to inflate their way out, right? They won't tell you publicly, but they're going to essentially slowly but surely reset the inflation target up to 3%.
Well, it's like after World War II. I mean, it has to be if you're going to get there.
Yeah.
At the same time. And, I've said this for a while, and people, I know they think that I'm not negative on the U.S. I just think we kid ourselves to think that the U.S. is in a power position like they would have been 40 years ago or 50 years ago. And we tend to think when it looks like everything is becoming, like you say, polarized, and it's becoming, there's some big people that don't want a piece of the treasuries or the dollar right now.
Let's all come down to the politician is in Washington. When you distort the cost of capital for longer and longer and longer for periods of time, you incentivize bad behavior. So because they've kept rates so low for so long, the behavior in Washington around, the cost of capital, there's no, even this year, like the Republicans and the Democrats, we ran up our deficit, to 1.7 trillion now in a full employment recovery. So in other words, they just don't care about responsible spending. And that's because they've been conditioned over and over and over by central bankers. And once that market mechanism starts to really push them to change their behavior, that's when things will finally change. But for right now, they just keep spending.
Well, I know, you make the point that over the next 10 years, I'm just extrapolating a little bit, but I know you feel in the book, you feel like commodities will be a place that you need to take a look at, as opposed, they haven't been around the last 15 years and people just sort of blew it off. But I do think you think that commodities themselves are going to be a situation with this inflation the next 10 years.
Yes, and companies like BHP or Rio Tinto or Freeport McMoran or Chevron. I mean, these are companies that just look at Buffett. Yeah. Buffett is dramatically taking down his exposure to technology, and he's almost doubled his position in Occidental Petroleum.
Right.
So I could see people doing the same thing. And once again, I'm going to say it one more time. So energy sector is worth $3 trillion. The technology sector, NASDAQ 100, is worth 24, was worth 24 trillion. 10 years ago, they were even. So we're going to see, and here's the most important part of the book. So the S&P 500 in a multipolar world after, say, 1968 to 81, the S&P was almost flat, right? But the commodity components in there, it all doubled and tripled. And in terms of 1981, industrials, oil and gas, and materials were 49%, Ted, 49% of the S&P's composition. 49. These things like were 13% last year within the last 9 months. So do we go back to 49? No, but do we go to 30, 35? Yes.
Well, I was, I don't know if you remember Rotan Mosley, but we were a firm down in Houston and that we sold out, but it was big energy. And so you had everybody in the world coming to go look at wells and do all sorts of things, you know, at that time. You know, they got caught up and into it. So it's interesting to say that. But you also talk about for the future, these hard assets, but you talk about gold a lot, your ideas on gold.
Well, the gold miners, for example, are so cheap to gold. Their balance sheets are in much better shape than the last cycle. They've delevered. But, you know, if you look at gold as a percentage of the market or gold miners, you know, in the 1980s, they might have been 2.5%, 3% of the market. And now they're like less than 0.5%. And so, yeah, they're really cheap. And then you got companies like Barrick that have moved into copper production and gold. And one of the things we talk about in the book, I mean, this power grid in the United States, Ted, is like 50 years old in some spots, 30 years old in others. And it's going to be a $2 trillion rebuild to support all of that artificial intelligence, all of those electric vehicles. And this is the greatest trade potentially of our lifetimes. And if you look at the copper mining facilities in the world, you know, we're way down relative to previous decades. So we've really suppressed the supply of things like copper. And now we have a big demand cycle coming at us.
I know Freeport is on your list, Freeport McMoran, because obviously I get your service, but is that one of your favorites in that area, Freeport, or would you have something like better?
Well, Freeport's the biggest balance sheet out there, and in terms of copper, I mean, it's one of, you know, it's the granddaddy. So, but First Quantum is a speculative one that has that Panama mine, and what happened was in the fourth quarter. This is another important. Why is this important for investors? Chile, Peru, as most people know, you're talking about 30-40% of global copper production comes out of Chile and Peru, right? And so if you look in these countries like Panama, Chile, and Peru, the politicians, the kind of the social political world is shutting down a lot of these mines. And so what that happened in the last administration in Panama, they shut this mine down. But when you actually look at how important these mines are to GDP of these countries, as the new governments come in, this kind of reversal. And what we think is they'll shut down the mine, but over, say, 40 or 50 years, you know, and keep it open. And so if that happens, First Quantum and names like that will do really well in this kind of world. But they have a lot of what we call jurisdictional risk.
You know, you do something in the book, and I've probably had this question, Larry, in my career 100 times, and that is, when is the best time to buy the miners and best time to buy the bullion? And you have, I'd like for you to describe it. You have a ratio between GLD, which is the gold, the bullion, to the GDX, which is the miners. And if you would just briefly describe that, it's one of the best I've ever heard, actually. But
yes, thank you, and we do it for Bitcoin too. The Bitcoin to gold ratio is really important, and they trade in these historical ranges. And what happens is, at the beginning of a commodity cycle, people hide out in what we call the mothership. It's safer to own gold, right? And central bank, remember, gold's a $16 trillion. I mean, it's a liquidity pool. It's the most liquid, vast pool in the world. You can trade more gold in one day. You can trade probably 50 times more gold in one day without moving the market relative to, say, crypto, right? And it's a lot more liquid than silver. It's a lot more liquid than platinum and palladium. So when you're in a period where the Fed's been hiking for long periods of time, it beatens up the miners, and the miners get really cheap to gold, and so that ratio gets really, really low, and that's where we are now. Whereas when you come into the commodity cycle and the Fed starts cutting rates, the fast money, the hot money, will then matriculate out of the commodity and into the miners.
And what is that percentage you use though? You have a percentage of what the GDX relative to the GLD. If it's below a certain point, and maybe don't recall it, but it's in the book for sure.
Yeah.
First time I've ever seen it actually. And right now the miners are cheap relative.
Yeah. And so, yeah, so all we do is you just look at what we do in HS screen. I can't remember the exact data, but we show it in the charts almost once a week. And so we look at the GLD versus the GDX, or we look at gold versus the GDX. And yeah, that ratio is really on multi-year lows.
And so how do you do Bitcoin with gold? How do you look at that ratio, and what would that be now?
Okay, so that one, it's easier to remember because more people, it's more topical. So when you're in like the gold, say, or Bitcoin to gold, when you're in the 7 to 16 times ratio, say call it 7 to 20, 22, 25, anywhere between the low 20s to 7. That's been the place where you want to be selling gold and buying some Bitcoin. But when you're in the 26 to 35 range, when Bitcoin is 26 times or to up to 35, that's when you want to be selling Bitcoin and buying gold. And we put that into some presentations, and it's worked for about 5 or 6 years now. No, more like 10 years. This ratio, this range.
Yeah,
And,
because it's 70,000, and gold at whatever, that's about 33 or 34 times.
yeah,
It's out of line.
got up to 30. It recently got up to over 30s again, and that lo and behold, in the last 2 weeks, we're back down again. Now, in other words, it failed again at that level for like the 6th time. And remember, since Lehman, the biggest gold drawdown is 21%. And Bitcoin has had 4 drawdowns of anywhere between 40% to 75, 80%. And think about that. I mean, and that's because gold's just a deep reservoir of liquidity. Biggest drawdown for gold is 21% since Lehman, since its last 16, 20 years. And the biggest drawdown for crypto has been 3 or 4, large ones. I mean, really bad. And it's very hard to invest in something that drops, 50, 60, 70% 4 times in, 8 years.
And so, in winding it up, let me ask you this, Larry. If you're talking to the average investor out there that is watching this, and there'll be a lot of people watching it, but the average investor that has some money in the market, and a lot of them today have a lot of money in equity. I mean, they're 60, 70, 80 years old, and they'll have, 3/4, 80, 85% in these indexes. But what would you say to the average investor? How should you look today, in your opinion, for setting yourself up for the next 5 years?
Well, the important thing is just to remember those periods, 68 to 81, where you get really a flat market, and with at least a 45% drop in the middle. And if you look at the same thing from 2000 to around, I think maybe it's 2000. Yeah, that's 12 years with another 40% drawdown. So those types of storms, they're not like people think that can't happen again. Those are 12 years. So if you're 70 years old and you 65, 70, and you've got all this money in the market, which we know once again the boomers control 78 trillion of wealth. A lot of that's in the market. They can't afford to take that risk because it could be another 10 to 12 year period with a 50% drawdown in the middle. And if you're an older person, that's catastrophic. So yeah, we think it makes sense to diversify into commodities. Some parts of the bond market are looking attractive again, and just a smart, much better strategy.
Well, I know in your service, and Bear Chips, you really have, one of the good things is you manage money, but you also put those management ideas in there about what to buy, what to cut back on, that sort of thing. But don't you think that where we are today and we have the most ever exposure to equity by individuals, and probably about pension plans for that matter. But I don't think, but how do you feel about alternatives with those pension plans? They have a, 30% or so. We're not high on it, but what do you think about it?
Well, there's different types, the private equity thing and the business development companies. We're starting to hear some really bad things around marks. There's old saying, there's the mark to market. There's a mark to myth. No, sorry. There's mark to market, mark to model, and mark to myth. That's it. Mark to market, mark to model, and mark to myth. And what happens with private equity and some of these alternatives, because they don't have to really market to market, they're clearly marking it to myth in a lot of cases, and a big reset's coming there. So you want to be careful. We're seeing, and if you look at the kind of the liquidity offerings that are coming in private equity, some of the people are cashing out right now, and there's new players coming in. So yeah, so just be careful with alternatives. There's good and bad. That's where they need people like you, Ted.
Well, also it's illiquid. I think people forget about that. The liquidity factor, as you know, you've been around a long time. When times go bad, liquidity pays.
Yeah. You might say you have $10 million in one of these things. If liquidity goes bad, they might allow you to get like 500 grand out a year for like 10 years or something. I mean, it's not a very comfortable place to be.
Well, listen, everyone out there, I want to show you this book again. And by the way, I can't tell you, this is a great book, and it will answer a lot of questions, a lot of things that you've been thinking about. And Larry, you did a great job on this book, and I see why it's the #1 bestseller, by the way.
Well, thank you, Ted. And it's working with a great team. Neil Ferguson, we were sitting in the Harvard Club maybe 7 years ago, and he's like, "You got to get another book out. You got to get another book out." And I'm like Neil, you've got 14 books out. How the heck do you do it? And he's like, you know what? There's no I in team. You got to put together a good team. You write it, but you also, get the right research people, you get the right contributors, and it's like bringing a puzzle together and trying to make it entertaining all at the same time. So thank you so much, Ted.
Well, listen, we're glad to have you, and hopefully you'll come back and visit with us next year.
Yes, absolutely. Anytime, Ted.
All right. Thanks a lot.
God bless, my friend. God bless. Thanks.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.